Hi, everyone. So welcome to the stream today. Very much excited for having you on the part 4 of our Consolidated Financial Statements series. I believe that it has been a very interesting series. Yesterday, we were having a couple of technical challenges. That is why we started late. And unfortunately, the live stream also ended in relation to that. But today we've got everything done and we've resolved all the issues in relation to that. So welcome to the stream. Very much excited for having you guys. Any questions you have, put it in the chat box. I'm going to be reading all of your comments and we'll be replying to them. I've seen some of you already with a thumbs up on the videos. So thank you very much for the thumbs up. I really appreciate it. If you're watching, give us a thumbs up on the video. It helps us that way. The video gets more engagement and YouTube will be able to push the video to reach as much people as possible. So today we are continuing with our discussion on the consolidated financial statement. Yesterday we solved a question on the statement of financial position in relation to that. And today we want to look at a question on the consolidated profit or loss. For some of you, you have received the questions already because it was sent to you on WhatsApp. Yesterday, you requested for it. But for those of you who don't have the question, this is an ACCA F7, that is financial reporting, December 2012. So that is the question, and you can download it if you want to download it in relation to that. A couple of you, like I mentioned, already have it because it has been sent to you. Now, this is a question on the consolidated statement of profit or loss, and we're going to be looking at the question in relation to that. Okay, so I see some comments already coming in. Hi, Samuel Corte is connected. Thanks. Wow, it says Sammy, thank you for joining the stream. I see David Sam. Good day. I am happy to be part of your today's class or your class today. All right, David Sam, give us a thumbs up on the video. Andrew Opoku Beko said, hi, sir. Hello, Andrew. I believe you are doing well. Jonas said, hello, hello. Hi, Jonas. I believe you are doing well as well. Give us a thumbs up on the video and then share the video if we need to get to some people who should be part of the stream. All right. Now, so before we go to the question for today, yesterday's question had something along with it that I wanted to also deal with for you guys. So let me open that question up real quick. There was a B aspect of that question that we needed to look at, but because the stream ended unexpectedly, I couldn't look at it. So let me go through that question even before we continue. Richard Opoku Ajiman, I see you. You are welcome. Xavier Ahido, hello, I see you. Give us a thumbs up on the main video page as well. That way we get more engagement on the video. So with yesterday's video, yesterday's question, there was a B aspect of that question that we did not discuss. Like I mentioned, the call ended unexpectedly. Our live stream ended unexpectedly because yesterday we were having just some technical challenges here, so couldn't live stream properly. So we want to look at the B aspect of the question we solved yesterday, Ranako, okay? And before we go to the question for today. So let's look at this question. Ranako acquired 30% of Walker Coal's equity shares on 1st April 20X5 for $13 million. Okay, so Ranako acquiring 30% of a company. Now, before we even go ahead, once they have acquired only 30%, it means this is an investment in associates. isn't it? So that's an investment in associate. Walker Co. had been performing poorly over the last few years, and Rana Co. hoped its influence over Walker Co. would help to turn the company around. In the year ended 31st March 2006, Walker Co. made a loss of 30 million. Rana Co. has no contractual obligation to make good losses. Give me a moment. Okay, so let's go. So let's go to that. So if we look at this question, this is a very simple question in relation to that. So all we know is that the business was acquired. If we look closely, 30% was acquired on 1st April 20X5. Okay, so if it was acquired on 1st April 20X5 for 13 million, that is the cost of the investment. The year ended under consideration is 31st March 20X6. So that is exactly 1 year, isn't it? Now, the company in this case made a loss of 30 million. So in order for us to get the amount, the requirement of the question is explain how Walker Co. should be accounted for in the consolidated statement of financial position for the year ended 31st March 20X6. So this is a very simple question. Investment in associate, that will be accounted for in accordance with IAS 28. So we'll take the cost of the investment, 30 million. Then we'll take 30% of the 30,000 and we'll subtract it from it. Then we'll get a closing balance in relation to that. So let's go to that. So that's Walker Co. And Walker Co is an investment in associate. So we could work 3 zeros out. Cost of investment. That's 13,000. And then we'll bring the post-acquisition loss. And that is 30% of the 30,000. And I think that should give us 9,000, yeah. So we take it out. So the current amount of the investment in associate is going to be, we pay 13 and this is 9. So that is going to be 4,000. So that becomes the carrying amount of the investment in associate. So this is the answer to the other side of this question that we are looking at. That is the yesterday's B aspect in relation to that. So that is very simple, straight to the point in that case. So let's move on to the day's business really and look at the question we want to discuss today. Any question? I hope everybody is okay with this. Let me know in the chat box if you have any questions. Let me know in the chat box. Emmanuel Addison, I see you. Okay, so I see some comment from Richard Opoku said, so you will record it in the statement of financial position. Yes, it will go to the statement of financial position in relation to that. So that is true in that case. But you know here, there is no need to extract the statement of financial position. The examiner said what should be the value at the end. So that is all we will be interested in relation to that. So let's go to the day's question. Now, like I mentioned, some of you have this question already because we've sent it to you guys. Now, in case you have not sent the question or you've not seen it, it is December 2012, ACCA F7, December 2012, question 1. Now, I see some comments. Andrew Opoku Beko said, "Say, about yesterday, I don't understand why the deferred consideration we use 21,000, but not 19,441. Beko, in terms of what? Is it in the statement of financial position you are talking about? Because when we were calculating the fair value of consideration transferred, we used the 19,446. Are you talking about the statement of financial position? Chachu, I see you. Richard Opoku, okay. Thumbs up on that. Okay, Andrew. Yeah, in the statement of financial position, we use the 21,000. We use the 21,000. That was what we used because this is what happens. The unwinding, which is the finance cost, has to be added to the present value. Are you okay, Andrew? So the unwinding, the 1554 has to be added to the 19,446 so that we get 21,000, and that is what goes to the statement of financial position. Always, that's how we deal with unwinding. The provision will go there, then the annual charge or the unwinding will be added to it, because the double entry for the unwinding is that we debit our income statement. In this case, we subtract it from the group retained earnings, and then we credit the provisions. That is why we added it back to the 19,446 to get a 21,000. So, Andrew Pokubeko, are you okay now? You understand? Okay. So let's go to the day's question. Like I mentioned, if you have any questions, you put it in the chat box and we are going to be answering that all. Now, today's question is on the consolidated statement of profit or loss or the group statement of profit or loss. Andrew said, I get it, sir. All right. So as always, let's go to the requirements and let's find out what's happening there. A said we should calculate the goodwill at the date of acquisition of Grisa. Calculate the goodwill at the date of acquisition of Grisa. Please note that there are two types of goodwill, always. There is goodwill at acquisition and goodwill at the reporting date. If you are looking for goodwill at acquisition, no impairment comes there. But if you are looking for goodwill at the reporting date, then if there is impairment in the question, you will deduct it. In this question, the examiner said we should calculate the goodwill at the date of acquisition. Then B says, prepare the consolidated income statement for Viagem for the year ended 30th September 2012. So our year ended is very, very important to us because that will tell us the period of acquisition for us to do various adjustments to the financial statements. So the year ended is 30th September 2012, and we are preparing the consolidated income statement. Okay, so once we know this, there are a couple of workings we are not going to be doing. Number one, we don't need to do the net asset of the subsidiary, that is at acquisition, at year end, and post acquisition. We're not going to do that. Why? Because we are preparing the income statement. If there is anything we will do, it's only the net assets at the date of acquisition. Does it make sense? Then we will not do NCI at the reporting date, really, in relation to that. Then we may not do group retained earnings because we don't need it here in relation to that. But we need our group structure. We need a net asset at the date of acquisition. Maybe if there is intra-group trading, we need to deal with it in relation to that. So these are the things that we need to understand about the requirements of this question. So let's go back up. Let me get rid of this line. And let's go back up. Remember, like I told you yesterday, when you are solving the consolidated financial statement or the group financial statement, you don't read the whole question before you start solving. You chew the question bit by bit, step by step, and work your way in relation to that. So the same thing we did yesterday, we're going to do that today as well. So let's see what's happening here. So right from the intro, we'll be able to do a couple of workings. So stay with me and let's see what we have. Remember, the year ended of the company is 30th September 2013. 30th September 2012. It's very, very important. 30th September 2012. So let's go. On January 2012, Viagem acquired 90% of the equity share capital of Grisa. Okay. So right there, what do you think we can do? You don't read all the question, you chew it bit by bit. So right from that very first line, middle of that first line, we see the group structure. So the group structure is that Viagem is the parent and then Grisa is the subsidiary. We see that Viagem is acquiring 90% of the equity shares. It means NCI, non-controlling interest, is going to be 10%. Then we need to look at the date of acquisition. In the question, we realize that the date of acquisition is on 1st January 2012. So if the date of acquisition is 1st January 2012, and our year ended is 30th September 2012, it means that the acquisition period is how many months? 9 months. Does it make sense? So right from that line, what we need to know is that the group structure, the date of acquisition, the reporting date, and the period under consideration. So just that middle of the very first sentence, these are the things we can do there. So let's look at the group structure real quick. So we are dealing with Viagem Group. So the first workings we're looking at is the group structure. So we see here that the parent is Viagem and it is acquiring Grisa 80%, and the non-controlling interest is going to be 20%, right? Then we need a date of acquisition. So date of acquisition, we are told it's 1st January 2012. That's the date of acquisition. And then the reporting date under consideration is 30th September, also 2012. So right from this, we see that the period of acquisition is 9 months. So this is what we can do from the half line we read. Remember, this is how you solve the question in the exam hall. Don't be in haste and read everything. Just read it and do, read and do, read and do. And that's how you work yourself out. So once we know it's a 9 months acquisition and we are preparing the consolidated income statement, it means when it comes to the financial statement of Grisa, everything that is in Grisa, we are going to take 9/12. Does it make sense? This is very, very important. Very, very important. So because we are preparing the consolidated income statement, the results, the financial statements of Grisa, we will take 9/12. Does it make sense? Then what it also means is that the profit that Grisa made during the year, they had been in operation 3 months before we acquired them for that year. For that reason, there has to be a pre-acquisition profit for the year. The pre-acquisition profit for the year. Okay, I'm seeing something. Please, the parents. Okay, it's 90. Thank you, Andrew. So it's 90 against 10. All right, thank you about that. So The profit that Grisa made for the year has to be splitted. 3/12 of that will be added to the net assets at the date of acquisition. So this 9 months is important for us when we are taking Grisa's financial statement, and is also there in relation to that. September 30th. September is 9. Oh, Nhyira. Okay. Thank you, Jonas. Okay. So 30th September. Thank you. That's why if you have the question, it's okay, so that we all go together. So this is our group structure. Everything good? Let's go and continue reading the question, and let's find out what is next. So on 1st January 2012, Viagem acquired 90% of the equity share capital of Grisa in a share exchange in which Viagem issued 2 shares for every 3 shares it acquired in Grisa. Okay, so immediately we read something like this. What comes to mind? Fair value of consideration transferred. So what it means is that we've seen component number 1 of the fair value of consideration transferred, and that is share exchange. They are issuing 2 new shares for every 3 share acquired. Okay, so we go to the financial statement of Grisa, and we see that Grisa's equity share is 10,000. So if it is 10,000 and we are acquiring 90%, it means we are acquiring 9,000 shares. Does it make sense? 9,000. We're going to be working at this properly. We getting 9,000 in relation to that. Now, of this 9,000, the share exchange is such that we give them 2 new shares for every 3 shares we have acquired. So it means if we want to get the number of share exchange, it is going to be the 9,000 times 2/3. Does it make sense? And always note that to be able to get the value, we have to use the share price of Viagem, the parent, because it is the parent that is issuing the shares. Does it make sense? Okay. So let's continue. Viagem will pay the shareholders, additionally, on 31st December 2012, that is 1 year after we acquire them, Viagem will pay the consideration of, Viagem will pay the shareholders of Grisa $1.76 per share acquired. Okay, so there are 2 components of the consideration transferred. We've seen the share exchange aspect, and then the second aspect is what? A deferred consideration. And the deferred consideration is a year from now. Now, since it is a year from now, what do? We look at the shares acquired, 9,000 shares. We multiply it by the $1.76 per share, and then we discount it using the cost of capital of the parent company. So in this question, we are told that Viagem's cost of capital is 10%. And so 1/R plus 1, okay, in relation to that. So it becomes 1/1.1, and then we discount it and get the present value in relation to that. At the date of acquisition, shares in Viagem and Grisa had a market value of $6.5 and $5.2 each, respectively. Okay, so we've been given the market price per share, which is what we need in order for us to value the share exchange. So we're going to be using Viagem's share exchange, Viagem share price 6.5 to be able to value the share exchange. Then we use the cost of capital still of the parent 10% to calculate the deferred consideration. Pawele, I see you. You're welcome. So that is what we do here. So now in the next workings, we want to calculate the fair value of consideration transferred. So let's go to that. So fair value of consideration transferred. Remember, we need this for the computation of our goodwill. So the first component there is the share exchange. And remember, we acquired 9,000 shares. So that's 9,000 times 2/3 multiplied by the share price of Viagem, and that's 6.5. Remember, we are told that the share exchange is that Viagem will issue 2 new shares for every 3 shares they acquired. So let's do the arithmetic of that. 2/3 by 9,000 times 6.5, and that gives us 39,000. Cledos, I see you. You are welcome. So that's 39,000. Then we bring the deferred consideration. Now the deferred consideration, we are told that Viagem will pay $1.65 per share. So that will be 9,000 times $1.76 times 1/1.1, because the cost of capital of the company was 10%. Okay, so that is the arithmetic. Let's punch that out as well. $9,000, 1.1, 1.76. I'm getting 14, should get 14,400. So we sum these two up, and that is what gives us the fair value of consideration transferred. So when we add these two, we get 55, 39 plus 14, that's 53,400. 53,400. So that is how we get our fair value, or the fair value of consideration transferred. So you see, just from the preamble of the question, we know the group structure, we know the date of acquisition, the reporting date, so we know the period. Then we are able to also calculate the fair value of consideration transferred. Does it make sense? Okay, so put it down and let's go. If you have any questions, put it in the chat box. If you just joined the stream, you are welcome. We are looking at a question on the statement of profit or loss, or the consolidated income statement. Do well to give us a thumbs up on the video. That way we get more engagement, and YouTube will be able to push the video so we can reach a lot of students across. My name's Grant Cardone. I'm the Can we go now? 1 minute. Okay, so let's go back to the question and then let's continue. So now that we've finished dealing with the preamble, we go to the footnotes and try to deal with the other issues there. But before we go to the footnotes, we will want to look at the net asset at the date of acquisition, so that we will be using that to calculate the goodwill. So let's go there. So let's see I see a comment coming in. Enoch said, please, on the deferred consideration, why didn't we calculate 2/3 by 9,000 before multiplying it with? Good. Now, Enoch, the deferred consideration, the question said, Viagem will pay the shareholders of Grisa 1.76 per share acquired. Per share acquired. So the number of shares they acquired, they are paying, or they are going to pay $1.76 per share. So that one, we don't do the 2/3. The 2/3 was done because we want to get the number of shares that were issued under the share exchange. Enoch, are you okay? Mohammed Nazif Suleiman, I see you. Enoch, are you okay? Let me know if you are okay. Okay, so let's go. So before we go into the footnotes and try to deal with whatever it's happened, Enoch said, please take it again. Okay. The deferred consideration, the examiner said, Viagem will pay the shareholders of Grisa 1.76 per share acquired. So if we want to look at the number of shares they acquired 90% of the 10,000, and that is going to be 9,000. So the deferred consideration is not charged on the issue of the shares, but the number of shares they actually acquired. The 2/3 is for us to get the new shares that is issued, or that are issued to the shareholders of Grisa. So when we are doing the deferred payment, the examiner said on the shares acquired. On the shares acquired. So how many shares did we acquire? We acquired 9,000 shares. For that reason, 1.76 multiplied by the discount factor, and that gives us the present value of that figure. Are you okay, Enoch? And remember, we're going to be calculating finance costs on that, just like how we did yesterday. We're going to be calculating finance cost on that, and that will be taken to the income statement as part of finance cost. So you make sure you keep that in your mind. Okay, so Enoch said it's clear now. All right. So remember I told you that before we go to the footnotes, let's try to get the net assets at the date of acquisition. So you're going to be doing this workings. I'm just going to direct you, then you do it before I come in. So if we look, this is the capital structure of Grisa. Okay, this is the capital structure of Grisa. We see that on 1st October 2011, which is the beginning of the year under consideration, they had an equity shares of 10,000 and their retained earnings is 35,000. But remember I told you from our group structure, we realized that the acquisition is 9 months. So they had been in business 3 months for that year before we came. For that reason, when we bring the equity shares and then the retained earnings, the profits they made for the year, that is the 6,200, we need to take 3/12 of that and add it to the net asset at the date of acquisition. Does it make sense? So if we are looking for the net asset at acquisition, we bring the equity shares, 10,000. I want you to do that as we go to the first note and we add it up to it, okay? So we bring the equity shares, 10,000, retained earnings, 35,000, then the profits that they have made for the year, 6,200, we will take 3/12 by that 6,200, and that is pre-acquisition profit. Pre-acquisition profit, okay? Because they had been in business 3 months before we came. So that portion must be added to net asset at acquisition. I hope everybody's okay on that. So do that, because I'll be looking at that as we continue with the notes. Any questions, please put it in the chat box. Asemeni Williams, I see you. You are welcome. Give us a thumbs up on the main video as well. That way we get more engagement. All right. So let's come to the footnotes. Now that we've got our group structure, we have our fair value of consideration transferred. We've started with the net asset at acquisition. Let's look at the footnote and let's see what's happening there. And I want you to stay with me closely here because of the structure of the footnote. So look at it. At the date of acquisition, the fair values of Greece's assets were equal to their carrying amount with the exception of 2 items. Okay, so all assets had no problem, but these 2 items had some problems. So let's look at it. 1, an item of plant had a fair value of 1.8 million above its carrying amount. Now, immediately we hear above, what do? It means this 1.8 million will be added to the net asset at the date of acquisition because it is above. I hope you are getting it. It is above. Then let's go. The remaining life of the plant at the date of acquisition was 3 months. Okay, so the plant is 1.8 million. The remaining life is 3 years. Then we are told that depreciation is charged to cost of sales. So it means we need to calculate depreciation on this particular asset. So that will be 1,800 times 1,800, and that will be times 3/12. No, let's not go that way. 800 divided by 3 times 3/12. Are you getting it? 1/8 divided by 3 times 3/12. I'll be illustrating that. I'm just explaining it for you. So the 1,800 will be added to the net asset at the date of acquisition, and then we compute depreciation, and that will be taken to cost of sales. Next one. Greaser had a contingent liability, which Viager estimated to have a fair value of 450,000 or 450,000. This has not changed as at 30th September 2012. Okay, so in addition to the fair value adjustment asset above there, they had a contingent liability, and the value at the date of acquisition was 450. So liabilities will reduce the net asset. So when we go to the net asset at acquisition, we need to bring this 450 there as a deduction because it is a contingent what? Liability. I hope you are getting the thing so far. Now, the final part says that this has not changed as at 30th September 2012. Assuming it had changed, then whatever adjustment will be taken to the income statement. but it hasn't changed. It means there will not be any movement on the contingent liability. GRISA has not incorporated these fair value changes into its financial statement. Right. So the financial statement of GRISA that we have here does not include these two items. So we have to include them. So now that we've read the note 1, let's put the pieces together and prepare the net asset at the date of acquisition. So let's go. Net asset. At acquisition. So the equity shares will be brought 10,000. Remember that, right? Then their retained earnings brought forward. I'm going to do shortcuts on that. So retained earnings brought forward on 1st October 2011. We are told that's 35,000. Then remember the profit I told you. That is the pre-acquisition profit. That's going to be 3/12 by the profits they made for the year, and that's 6,200. So we do the arithmetic of that. 3/12 by 6,200, and that is 1,550. Okay. Then the fair value adjustment. Two components, the plant will be brought, and that was given to us as 1.8 million, so 1,008. Then the contingent liability recognized, that's 450. We deduct it because it's a liability. I hope you get a concept. So these are the things that comes there in relation to that. So let's add all up, and that gives us the net asset at the date of acquisition. So let's see. So this will be 45,000, 1,550, 1,800 minus 450, 47,900. So that is my net asset at the date of acquisition. And this is what we will be using to compute the goodwill. Any question? I believe you are following. You see how simple consolidation is if you read it bit by bit and work along in relation to that. It's very simple, very, very simple. So you comment in the chat box with any questions you have. Everybody okay? Can we go? Okay, so let's go back. Let's go back to the question and let's go to note 2. Richard Opoku Ajiman said, please, the retained earnings calculation. What about that, Richard? What do you want to know about that? Or what's your challenge about that? Enoch, is the profit for the year 6,200 included in the retained earnings of the 35,000 at the reporting date? Certainly it will be, no. This 35,000 is the opening figure, not the closing figure, not the reporting date. Because look at the dates we have there, 1st October 2011. So Enoch, the 35,000 is not the reporting date. It is the closing figure in relation to that. Richard Opoku said, okay, Mohammed said, please, the pre-acquisition profit is 3/12 instead, not 3/2. Oh, did I do 3/2? Oh, okay, I wrote 3/2, but it's supposed to be 3/12. Yeah, thank you very much. Okay, Richard Opoku, it's okay now. All right. Enoch said the date was answered. The date has answered my question. Sorry, I didn't see it. Okay. All right, so let's go to note 2. So we finished with the note 1. Let's go to the note 2. Note 2 said, Viagem's policy is to value the non-controlling interest at fair value at the date of acquisition. For this purpose, Greece's share price at the date or at that date can be deemed to be representative of the fair value of the shares held by the non-controlling interest. Okay, so if we want to value the non-controlling interest NCI, it's simple. The examiner is telling us that we should use Greece's share price. So all we would need is how many shares are the non-controlling interest having, and then we multiply that by the share price of Greece. So let's see. Viagem acquired 10,000 shares, sorry, 90% of the 10,000. It means NCI owns 1,000 shares. Does it make sense? Okay. So if they own 1,000, we multiply that by the market value per share of the shares in Greece, and that is 2.5. Are you getting the concept there? That's the 2.5 in relation to that. So value of NCI at the date of acquisition is 1,000 times $2.5 per share. I believe you can do that, right? Oh, I need to do that. Let's go to that. So fair value of non-controlling interest at acquisition. That's gonna be 9,000 shares, 1,000 shares rather. 1,000 shares multiplied by $2.5 per share. And that should be 2,500 shares in relation to that. So that is the fair value of the non-controlling interest. Very simple at the date of acquisition. So we're going to be using this figure in the computation of our goodwill. So let's go back to our question. Workings 3. I want you to stay close with me here because note 3 rather looks like intra-group trading issue. So let's look at it. This is how it reads. Sales from Viagem to Greaser. So who is selling here? The parent is selling to the subsidiary. Okay. Sales from Viagem to Greaser throughout the year ended 30th September 2012 had consistently been 800,000 per month. Now be careful here. You remember our period of acquisition here is 9 months. And so, and we are preparing the income statement. Because we are preparing the consolidated income statement, we need to get a total sales. So to get a total sales is going to be 800,000 times 9. And that's going to be 7.2 million, or if you want 7,200. Now, why do we need that? Because in the consolidated income statement, we need to subtract the total sales from the revenue and subtract that same figure from the cost of sales, because intra-group trading must be eliminated. Does it make sense? So 800,000 per month. So we need a total sales, and that is 7,200. And we will debit the revenue and credit cost of sales, meaning we deduct it from the revenue and we deduct it from the cost of sales. Keep that in mind. Keep that in mind. Viagem had a markup on cost of 25% on these sales. Okay, so we have the selling price, but the examiner has given us a markup. So we are moving from markup to margin. And remember in my explanation, I told you that we can use the KG method or we can use the professional method, isn't it? So it depends on what we want to use here. But let's look at how many of the inventories that were actually, or how much inventory that was actually in stock. Greaser had 1.5 million of these goods in inventory as at 30th September 2012. So whilst the total sales is 800 by 9, 7,200, which will be deducted from the revenue and then from the cost of sales on the face of the consolidated income statement, there is going to be provision for unrealized profit on the 1.5 million. And remember how we treat provision for unrealized profits. We are going to be debiting the cost of sales and credit revenue, meaning the provision for unrealized profit will be added to the cost of sales. So that is the note 3. Hope it makes sense. So let's go put the workings of that together. So that will be workings, what? 3 or 4, something like that. Let me see. 1, 2, 3, 4. Maybe this could be workings 5. Intra-group trading. So remember, the first thing is to the total sales. And we said that's going to be 800 by 9, and that is 7,200. So like I mentioned, this 7,200 will be deducted both from the cost of sales, and then from the revenue. So you debit revenue, and then you credit cost of sales. That's a double entry if we want. Then we go to the provision for unrealized profit. Now, we could use the KG method or the professional method. Let me do the KG method, then we will do the professional method as well. Then you choose what you like. So selling price equals cost price plus profit. This is the KG2 method. The inventory in stock is 1,005. We don't know the cost price, and the markup is 25. So it means it's going to be 1.25x equals 1,005. So our x will be equal to 1,005 over 1.25. And that is going to be equal to 1,200. So remember, the 1,200 is the cost. So if I want the profit, my provision for realized profit will be equal to the 1,005 minus the 1,002, and that's going to be the 300. Okay, so if we want to use the KG2 method, this is how we go about it to derive our provision for realized profit. Remember the double entry for this 300, we will debit cost of sales. So this 300 here will be added to the cost of sales. Are you getting it? If we don't want to use the KG2 method, we can do the professional method, which is going to state that so let me put the professional method also down to be the same thing though. So provision for realized profit will be 25, 125, 1,005. And that should give us the same figure, 300. Yeah. So that is our provision for unrealized profits. Like I mentioned, it will be added to the cost of sales. So that is the workings 3. Any questions? I hope we can go to the next note. So let's go to the note 4. I want you to pay close attention here to the note 4. Viagem's investment income is a dividend received from its investment in a 40% owned associate, which it has held for several years. Listen carefully. Viagem's investment income is a dividend received from its investment in a 40% owned associate, which it has held for several years. So it means there is an investment income somewhere, and you can see it here under Viagem that they have an investment income of 500. We are told that this investment income is a dividend they have received from an associate. listen carefully. In the income statement, it is not the dividend received that is recorded, rather it is the allocated or share of profits for the year that is brought. So the entity Viagem is not supposed to have written that 500 there as the dividend they've received. No, they are supposed, or they were supposed to rather bring 40% of the profit for the year of the associate. So that is an error there. So you have to know it's an error so that when you are doing the consolidation, that doesn't come. So let's go back. It says the underlying earnings for the associate for the year ended 30th September 2012 were $2 million. Okay, so the associate made a profit of $2 million. And so share of the associate profit will be 40% of the $2 million. And that is what will go to the consolidated income statement and not the dividend received. I hope it makes sense. So let's work that. So investment in associates, simple, share of profit, that's going to be 40% of the 2 million, that's 2,000. And that's going to give us 1.4 of 2,000. That's going to give us $800 or 800,000. So when we are preparing the consolidated income statement, where we see the investment income, we will replace this with share of profit from the associate, this 800. I hope you are following the picture. Any questions, please put it in the chat box. Can we go to the next note? We are getting a bit closer to the end. So to the note 5, I guess that's the last note. Then we now prepare our financial statements. Although Greaser has been profitable since its acquisition by Viagem, the market for Greaser's product has been badly hit in recent months, and Viagem has calculated that the goodwill has been impaired by $2 million as at 30th September 2012. Okay, so the final note is about impairment in goodwill. So impairment in goodwill will just be taken to the administrative expenses in the income statement for the year under consideration, okay, as part of the administrative expenses. So basically, that's all. We're almost done. Any questions? Any questions? So let's go over our workings so far as we tied them up. So we have our group structure here. If you have any questions, please put it in the chat box. So we have our group structure. Remember this 9/12? That is what we're going to be using to allocate or to apportion GRISET's figures in the income statement. So that's our group structure. We know it's 9 months in relation to that. Then fair value of consideration transferred, we computed that, and that is 53,400 in relation to that. Then we came to the net asset at the date of acquisition. We brought the equity shares, retained earnings at the beginning of the year. And then we said this was a 9-month acquisition. So the profit for the year has to be divided. So we got a pre-acquisition profit, and this is 3/12, not 3/2. So 3/12 by 6,200, and we got 115. And then there was a fair value adjustment of a plant of 1,800, of which, if you remember, I told you we will be calculating depreciation on that. And remaining life was 3 years. And then there was a contingent liability of 450. We deducted that, and we got 47,900 as the net asset at the date of acquisition. Then we came to the valuation of the non-controlling interest. We were told that the non-controlling interest was valued at fair value using the share price of GRISA or GRISA. So the NCI share will be 1,000 shares, and the share price of GRISA was 2.5, and so we got 2,500 for the fair value of consideration transferred. Then from there we came to the intra-group trading. Every month the parent was selling to the subsidiary $800,000, and the period is 9. So we got our total sales to be 7,200. And we said that this total sales, 7,200, we will subtract it from the revenue and subtract it from the cost of sales as well. Then we also said there were some of the goods in stock at the reporting date. So we need to calculate the provision for unrealized profit. The goods in stock was valued at 1,500 or 1.5 million. The markup was 0.25%. And so we got a provision for unrealized profit of 300. And we said it must be charged to the cost of sales in relation to that. So this is also the professional method. Provision for unrealized profit, this is the KG2 approach. And then this is the professional method in relation to that. You just add it up. Then there was an investment in associate, which we got a share of profit to be 800. And I told you that we're going to be taking this 800 to the income statement in relation to that. So these are the workings we have so far for this question. Any questions, please? Any questions? So let's go and tidy up our workings and finish it up. We can calculate the goodwill since we have everything we need to calculate the goodwill in relation to that. So let's go there and let's calculate our goodwill. Especially that is the A aspect of the question, right? So goodwill. In this question, that was 4 marks. So goodwill. No, my touchpad is just misbehaving. Okay, so we got it now. 3 zeros up, percentage. So fair value of consideration transferred. We did the workings for that. That was workings 2. We own 90%. And I think, let me go back to my workings to see the figure we had there. That was 53,400. So we bring that up. Then we bring the fair value of the NCI. We did the workings for that. That is 10%. And I think we had 2,500. So this gives us the value of the business. And when we add this up, this is 55,900. Then we bring the net asset at acquisition, which we did workings for, and we had 47,900. So we less, and then we get our goodwill. And our goodwill, we less from 55,900 minus 47,900, and that's going to be 8,000. So this is the A aspect of the question, computing our goodwill. Very simple, right? Can we go? So let's go to the B aspect of the question. That is preparation of the income statement in relation to that. But you realize that our cost of sales will have a lot of workings, and I wouldn't want to make it clumsy on the face of the financial statement. So let's do workings for the cost of sales, because there are a lot of items that must go into them. If there are any questions, you put it in the chat, okay? So cost of sales. Slashing our dollar sign. Now, Andrews Opoku Beko said, "Sir, would not the impairment have effect on..." I don't get your statement, but I think you are talking about the impairment. The examiner said we should calculate the goodwill at the date of acquisition. So at the date of acquisition, the impairment will not come in. It is goodwill at the end of the year. If we are taking it to the consolidated statement of financial position, that's where the impairment will be deducted. So in this question, we are calculating goodwill at acquisition, so no impairment. Does it make sense? So that's how it's done. So let's look at our cost of sales. We bring the parent cost of sales, so Viagem's cost of sales, from our financial statement and in their income statement, we realize that, okay, 51,200. Then we bring Greece's cost of sales. Remember, all the results of Greece are, we are going to be taking 9/12. Does it make sense? 9/12. Everything 9/12. So when it comes to Greaser, we will take Greaser's cost of sales, 26,000, 9/12. So let's punch that out, 26,000, 9/12. And that gives us 19,500. Then there was an intra-group trading. So the total sales, get that well, intra-group sales, we did the workings for that. We got 7,200. That will be deducted here. Then provision for realized profit, we did the workings for that as well. And we got 300. Has to be added to the cost of sales. Then the additional depreciation on the fair value adjustment. So additional depreciation, that's 1,800 by 3 times 9/12. So let's get it, 1,008 divided by 3, 9/12. That gives us 450 and will be added as well. Right? So we add it up and we'll get a total value for the cost of sales. So 51,200, 19,500 minus 7,200, the intra-group sales, plus 300 plus 450, and that gives us 64,250. So this is our cost of sales. We're going to be bringing that as a one-liner item on the face of the financial statement. That is the income statement. Any questions, please put it in the chat box. Okay. So let's continue. And now let's go to the income statement and put the pieces together in relation to that. Now, because of the way my pad is being small, I can't do a lot of the workings on the face of the financial statement. So I'm going to be doing them piece. When I finish, I'll bring the absolute figures. But we could have done the workings on the face of the financial statement. But because my notes pad is small, I will not be able to do that. So I'm just going to do the workings piece by piece. Then we get the final answers up. You don't need to do this in the exam hall. Outside the cost of sales that I did, the rest of the workings could be done on the face of the financial statement. So let's go. Let me get a revenue. So when it comes to the revenue, we're going to be bringing the parents' revenue. So via GEM, 64,600. Then I will bring Greaser's revenue. Remember, everything about Greaser, we are taking 9/12. So 9/12, and the cost of sales of Greaser is 38,000. So let's get the answer for that. 9/12, 38,000. That's 25,350. Then the intra-group sales $7,200. Remember, the same figure was deducted from the cost of sales. So we'll deduct it here as well. So 64,600 then minus 7,200 64,600 plus 25,350 minus 7,200. Oh, this figure should be 28,500. Yeah, should be 28,500. So my total sales will be 85,900. So that is the revenue on the face of the consolidated income statement. Remember, I said you are not supposed to do this working separately. Okay, you're not supposed to do this working separately, but I'm doing it separately because my board or my notepad here is small and I can't squeeze the things up in relation to that. So that's our revenue. Put it down. Let's go. So the next item we've already done cost of sales, so we can go to distribution cost. Yeah, Cletus, 9/12 by 38,000 is 28,500. We have corrected that. So let's go to the distribution cost. We bring Viagems and they are 1,006. Then we bring Greaser. Greaser did 1,008. Remember, we are taking 9/12 of everything. So 1,008, 9/12. That's 1,350. So we add it up, and that should be 1,950. 29 rather. So this is our distribution cost as well. Remember, like I said, we could do all these workings on the face of the financial statements. Next one, administrative expenses. So let's go. So admin. So with the admin expenses, Viagems on, they have 3,800. And then we are going to bring Greaser, and they had 2,400. Remember everything, we're going to take 9/12. That's 1,800. But administrative expenses, remember the impairment, that was the final note. So we're going to bring the impairment in the final note. That was 2,000. So this adds up should be 6,600. So that is also our figure for the admin expenses. Then we go to, remember I told you that the income of 500 will be replaced with the workings we did in relation to the investment in associate 800. So we've already done that working. So there's no need we bring that up again. So let's go to the next one, and that'll be finance cost. Remember that the finance cost, there is some unwinding we need to do on the deferred payment. Don't forget that. So finance cost. So Greaser had 420 in the finance cost, but oh no, not Greaser, Viagem, because Greaser had no finance cost, but Viagem is also not having, or is not having finance cost, but we need to bring the unwinding of the deferred consideration. So deferred consideration, so 14,400 by 10%, but it's going to be 9/12. 10% because that's the cost of capital of the company. So we work that out. 14,400 by 9/12 by 10%. That's 1,080. So you add that up, and that should give you 1,500. So that's our finance cost as well in relation to that. Then the last but one we go to is the income tax. So income tax, RISA is having an income tax of 2,800, not GRISA, via GEMFES, the parent. And then GRISA has 1,006. We are taking 9/12 of that. 9/12, 1,600. That's going to be 1,002. So that's going to be 4,000 for the income tax expenses. Does it make sense? Good. So these are the workings we do in relation to that. Then the final workings we need to do is that at the end of the financial statement, we need to look at profits attributable to the non-controlling interest. So to do that, we need to get a profit for the year for the company. So before we go to the financial statement, let's work that out. So let's see, profit. This is post-acquisition profit, actually, so that we can get how much will be allocated to the NCI. So the profit for the year, 6,200, 9/12. Remember that, right? 9/12, 6,200. We get 4,650. Then the various adjustments, there was depreciation of 450. It has to be deducted. There was an impairment in goodwill, and that will also be deducted of 2,000. So we take these out. So 4,650 minus 450 minus 2,000, that gives us 2,200. So if we want the profit allocated to the NCI, it's going to be 10% of this, and that's going to be 220. So this is the profit attributable to the NCI, or the non-controlling interest. Does it make sense? So we are done. Literally, we are done in relation to that. So let me put all these on the face of the financial statements for you to see how it adds up. So just a quick cover up or review. We've calculated our cost of sales. We get our total revenue here. We get our distribution cost. We get our admin expense, finance cost, income tax, profit for the year, and the one allocated to the NCI. So let's prepare the financial statement now. So Viagam or Viagem, consolidated income statement for the year ended 30th September 2012. Write that in full, okay? So that's our heading. So you put it down in relation to that. So I'm going to divide my screen. I'm going to try to divide. So let's bring the items up. Straight up, we got our revenue. So assuming you are preparing the statement, you do the workings on the face. We got 85,900. Then we bring our cost of sales. Did the workings for that, 64,250. We take that out to get a gross profit. And that will be 21,650. Then we bring distribution cost. Remember, we did the additions for that, 2,950. That will be less. Then we bring admin or administrative cost or expenses. We did the workings for that at 7,600. Then I told you that we will replace the income of 500 with the income from or profit from the associate. So income from associate. We did the workings for that and we had 800 to be added up in relation to that. Then from there, we continue with the finance cost, and we got 1,005 for that. So you less it, and we will get the profit before tax. And that is going to give us 10,400. Then we bring the income tax. We did the workings for that with the addition, and we got 4,000. So you take it out, and that gives you the profits for the year. And that is 6,400. Opoku said if there was a movement in the contingent liability, will it affect the NCI share of profit? Yes, it will affect them. It will affect their profits. It will affect. Because the contingent liability was in the book of the subsidiary, GRISA. So definitely it will affect them in relation to that. So when you finish like this, you must share this, okay? So we say profit for the year attributable to, so we share how much must come to the controlling interest and how much must come to the non-controlling interest. We did the workings for the non-controlling interest. We said it should be 220. And so if the total is 6,400, then the balancing figure should go to the controlling interest or equity holders of the parent company, and that is 6,180. So this is how we prepare the consolidated income statement for the year ended 31st September 2012 for VRGEM. Any questions? Richard Opokwa-Jiman said, please, can you tell me the treatment? Okay, are you referring to the treatment in the contingent liability? Assuming it was 450, so assuming it has increased, then we will subtract it from the profit for the year of the subsidiary, because when your liability goes up, it becomes an expenses and it reduces our profits. But if it has reduced, then it will be a gain. Then it will be added to the profit for the year for GRISA in relation to that. Any other questions, please? Are we okay? Okay. So this is what you have to understand when we talk about consolidated financial statements and the various adjustments that must be done in relation to that. So you can put any questions you have. Andrew Poku Beko said the NCI share of profit is 2,200. Is it 2,200? Andrew, are you sure? The entire profit made was 2,200. Andrew, the entire profit was 2,200. So we take 10% of that, and that will be 220. Okay. So the NCI share of profit is 10% of the 2,200, and that will be 220. 220. Richard said, will you also treat it in the statement of profit or loss? Yes, definitely, because it will be added to provisions, right? Right. So it could be added to your administrative expenses or subtracted depending on whatever is happening to it in relation to that. Okay, Andrew said he's okay on that. Any other questions? So this is what you must understand about the consolidated financial statement. So like I mentioned earlier, we've tried this week to focus our attention pretty well with consolidated financial statements, gone through the principles that we must understand in the preparation of the consolidated financial statement. And then yesterday and today, we've tried to solve some questions on the consolidated financial statement. So any questions, let me know in relation to that. What else would you want me to cover in this slide? Is there any other thing you will want me to talk about in relation to that? So I'll be concluding around here today. Tomorrow, I'm doing a live Q&A session on our Facebook group. So in case you are not part of the group, you can join its Premium Professional Hub. If you go to my Facebook page, you will see the group and then you'll be able to join. It's a private group. So I'll be doing a live Q&A session tomorrow on the group where I'll be answering your questions and also providing you with some strategies as well. So you stay tuned. Tomorrow we'll be having that discussion there, and I'll be releasing a video on the channel. So tomorrow I'll not do live stream on YouTube, but we'll be releasing a video on YouTube, but I'll do a live Q&A session on our Facebook group, Premium Professional Hub. That's the name of the group. It's a private group. So you go to my Facebook page and then you can get the link to be able to get access and join the group in relation to that. So thank you very much for spending the week with me and spending time with me in what we have done throughout the week. So Mohammed, Enoch, Asomeni, Opoku, Andrew, Kletos, and all of you guys. Thank you very much for joining the stream. It's always a privilege to come your way. Remember, my objective is to be able to provide you with assistance, help you to solve a couple of questions and deal with the minor challenges that you have so that you can build your understanding very well. So when the exams date is announced, you will not be freaked out. You'll be well prepared and you write the exams and come out with flying colors. All I want from you is that you make sure you study, don't give up, continue to work hard, study very well in relation to that, and also continue to share the channel with your friends, your colleagues, and loved ones so that we can get as much people watching these videos, being affected by this video, so together we can reach more people and touch more people's life in relation to that. Damilari, I see you. Thank you as well. You are welcome. So thank you very much for joining the stream. So I'll see you tomorrow on our Facebook group, Premium Professional Hub. We'll be doing a live Q&A session there. The time will be announced in the group, and I'll be releasing a video on YouTube tomorrow to assist you in relation to what you are doing in relation to that. We are planning to do a Zoom masterclass possibly around next week. It will not be streamed on YouTube. So once you are following, the details will be available on my Facebook page as well as on the community tab on the YouTube channel so that you can follow in relation to that. Richard Opoku Ajeman said, I really appreciate you. It's a pleasure, Richard. Thank you. Cleto said, thank you very much. You are welcome. Thank you too for taking your time to watch the stream with me. So continue to take care of yourself. Remember, coronavirus is still here. So you make sure you wear your face masks, you sanitize your hand, keep social distancing, and all of the things they said we should do. But above all things, keep your faith high, continue to trust in God, continue to trust in your dream. Don't give up, keep working hard. I know the sky is not the limit. It is the beginning of your success. I'll see you tomorrow as we continue with our discussion. Good night and bye-bye.